Welcome to the EXP Group's discussion of ACCA paper P5, Advanced Performance Management. Today we just want to cover some big picture issues with regard to strategic performance measurement, particularly with the starting point. The starting point is that in order to measure relevant things regarding performance, we have to have an idea of what the overall objective is of an organization. The most general starting point would be the mission statement, and this is something which everyone is familiar with, even if they're not totally convinced by the meaningfulness of a mission statement. The mission statement should articulate what the company is all about and reflect what its core values are. If we move down a step from the mission statement, we can see that the mission statement should give rise to a company's corporate objectives, and the corporate objectives become more concrete with regard to the sorts of things that it wants to achieve, things that can be measurable. And strategy is a planning process for converting corporate objectives into reality. At the most basic level, we could say that then we have corporate targets, planned outcomes of actions. This is more at the tactical and operational level. Now, in support of the planning and strategic making at a company, the company needs to know what the critical success factors are, the CSFs, in its industry. This is a notion which is already should be familiar to candidates in this paper. So we must determine the critical success factors. What is it that a company has to do well in order to be really competitive in its business? And then from the critical success factors emerge the key performance indicators, those things which are specifically measured to be able to answer the question, is the company actually fulfilling or able to perform effectively with regard to the critical success factors? Now let's just look at the strategic performance measures, some typical measures in the private sector. The underlying assumption is that for-profit companies are seeking to create shareholder value, to maximize shareholder value. And in connection with this, here are some typical financial measures that many people will be familiar with. The return on investment notion. So this is looking at how much profit, however, which way we define it, what kind of returns we can generate based on the resources known as capital employed that we have tied up in the business. Earnings per share is a very common investor approach to understanding business performance. If you're an investment fund looking at businesses, EBITDA has been a very favored way of assessing the operating performance of a company, EBITDA being generally sort of a cash-based measure. If you want to get more sophisticated, internal rate of return is a way of expressing the returns generated by a project. And the definition, the internal rate of return is that discount rate where the net present value is equal to 0. This is again a review from earlier papers. One can compare the NPV, net present value, appraisal method with IRR methods. This has also been discussed extensively in related ACCA papers. Just to remind ourselves that paper P5 is not devoid of all numbers. Here's just a quick reminder of the ways in which IRR can diverge from the net present value. We have two projects here. The IRR in project A is 20%, but if we were to apply a discount factor of 10% to the projects, project B would look more attractive from an NPV point of view. We also know that the In cases of ambiguity, the net present value method is more important or dominates and should be given preference over IRR. That's just the rule we have. In this particular example, one should remember that the ambiguity that arises is not caused by differing investment amounts. We can see here in the case, in the second example, that even equal investment amounts can give rise to the seeming discrepancy or ambiguity or conflict that can exist between NPV and IRR. And finally, if we move into the sophisticated sort of statistical-based performance measures, Six Sigma is one method or approach which has been pioneered originally by the Motorola Corporation, but has been applied to many companies in the meantime by consultants, and its focus is on the elimination of errors, and the goal being Six Sigma refers to sigma as a standard deviation, and if we're talking about six standard deviations, we're talking about squeezing the error rate way down to the method seeks to reduce error rates down to something like 3.4 defects per million. That's probably just a that number is just used to illustrate the impact of a Six Sigma program.